The angle of attack has changed. The Fed has said this is not going to be some triangle sawtooth. It's not going to go up sharply and then come back down sharply, which is what we would all want if we wanted things to get back to normal sooner. The angle of attack is now a little bit slower, which means it's going to take longer to get where we need to be. And then we're going to stay there for a lot longer than we want. And when you roll those two things together, a lot of companies may run out of money. You have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think. And they'll be higher for longer than all of you want. And again, without debating whether, that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that, the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits. And that's going to affect how companies get money, the cost of capital, so how much dilution you have to take. So I think this is what companies are now bearing down for. They're realizing, oh man, I need to get my cost structure way in line. It is way better now, just to think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%. This is an incredible slide. And essentially what it shows for those folks that are not watching this on YouTube is it essentially shows the private software universe and then the public software universe at different levels of valuation. So as an example, right now, there are 15 companies, private companies that are valued greater than $10 billion. And there are 40 public ones that are valued greater than $10 billion. There are 50 companies between, more than 5 billion, but only 60 that are public that are valued more than 5. And here's what's crazy. There are 400 companies who have an average valuation of 3 billion. And then there are already 70 companies in the public markets where they have $1 billion of next 12 months of revenue. And it just goes to show you, to your point, Freeberg, if these folks have to generate an 11% hurdle rate, their cost of capital is 11%. The companies on the left will have to go through a lot of very difficult cost cutting, potentially headcount reductions, repricing of the product. The point is that you didn't have to do this when rates were zero. There was just an abundance of free money and risk seeking and duration that is now out of the market. Coinbase versus Carvana, right? These are both businesses that issued convertible debt sort of right before things got very, very hard. And if you look at where their convertible debt trades, it's trading basically at an implied yield of about 12 or 13%. Both companies. Now, one is probably, a legitimate bankruptcy risk, which is Carvana. That's what the market would think. Whereas the other one, I think it has a very fortified balance sheet and could weather the storm, Coinbase. But unfortunately, in a moment where, rates are, again, the risk-free rate goes to 5.5, our cost of capital to do business goes to 10 or 11. These guys have to pay 12 or 13%. My gosh, it's really, really dilutive to be in business right now. So it just goes to show you that you can stay public, but if you want to get incremental money to cover your burn, the only way you can do it without really, blowing up your cap table and doing a massive recap will be through convertible debt. But it has a huge overhang and you risk turning the keys over to the debt holders of the company. So the alternative for that business is to go into the hands of private equity and get out of the spotlight of these public markets But private equity is very smart. And the thing that's happened to them is they can't raise debt. There is no free lunch anymore, I think is the big point to point out anywhere in the market right now. The thing that, again, people should do is you should just build a little spreadsheet for yourself to understand what the alternative financing options are for people who are in the business of investing. So David, to your point, the current 3-month T-bill rate is 4%. You can buy munis now between 4 and 5% that are triple tax advantaged, right? You can buy high quality corporate bonds that are 6, 7, 8%. And so all of a sudden, like turning around and giving it to a company where there is no end in sight in terms of it doesn't get you to profitability is a really, really hard thing to do. I was talking to an entrepreneur, David Soloff, just yesterday, and he said it really well. He's like, listen, I'm not a macroeconomist. I'm not trying to forecast, but he's like, what I understood yesterday, this is David talking about the Fed, as an entrepreneur. And so if you can't get to default alive, you have to look at your cost structure and figure out how to right size this thing, because the cost of capital is just going to be really, really expensive. Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix if they undercorrect and they have rampant inflation. I mean, not more explicit you can't get, Jason. So he's going to take rates until demand is destroyed, and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us because we all have to do our job trying to build a company, trying to raise money, trying to invest money. It's just getting much, much, much harder than I even thought. So for me, I'm like, wow, I thought that we could get through the worst of this by mid-23, but now you have to plan for the worst, which means, okay, now I'm thinking that, man, rates could be higher for much longer, which means, we could be in this market till early 25. And you may say, hey, that's way too conservative. Yeah, but you have to plan for conservatism in this point. So how do I invest money right now? Honestly, I'm like, I should just put it more into T-bills. Isn't that crazy? If a company's like, hey, Chamath, can I have another 10, 15, 20 million bucks? I'm like, wow. I mean, I don't think that gets you anywhere. And oh, by the way, that 10 or 20 million dollars, I can generate 4%. What a tough trade-off, right? I just don't see anybody rewarding hypergrowth that is burning a ton of cash, where you have to be back in market every year, because it's just very hard to feel comfortable that the conditions on the field aren't going to be drastically different a year from now, right? It's not like we know that it's going to be better or worse. And I think that uncertainty is actually really bad for companies. So to your point, it's just like a lot of folks have tried to shy away, David, from actually revisiting their valuations. They've done these complicated converts, and they've tried to basically, I think it's sort of like managing their ego or the board's ego. And I think like the next shoe to drop has to be these founders and these boards just saying, okay, let's just take the hard medicine. What's the real, market clearing price and valuation? Let's get a third party to price it, and let's get new fresh equity and then move forward. Because if you don't do that and you wait until everybody's trying to do it, then it's going to be a really tough scenario. So better, to your point, this is why like Stripe, it's so smart. Better to cut now. Again, it's always hard to let people go, but it's better to do that now than 18 months from now. This is just math, It's not a judgment on any of these companies. It's just pure math. This is why I think you have to be utterly unemotional in this moment. And if you're a CEO running a company, particularly a SaaS business, you have to really figure out how to right size your cost basis.